We're in the silver catches up part. That implies we're towards the end of this bull market. We don't want silver to catch up yet. We want, years ahead of bull market to run. I expect silver to consolidate again at some point here. Maybe it goes up. The technical guys tell me it goes up to 68, something like that, just below 70, and then maybe corrects for a while. I'm bullish because silver's gone up for idiosyncratic reasons. And if it corrects for a while, I think that creates buying opportunities before the next big leg up. But he's been into gold for many years. For, JP Morgan, that institution that gold bugs love to hate, the leader of that institution to come out and say, well, you know what? It's not just, crazy people who want to own gold these days. That is a huge shift. And we were looking at $5,000 gold, $60, $70 silver. I'd be very worried that we just hit a peak and the next big move would be downwards. And then you've got the trade war, which isn't just a trade war. This is global superpowers, China and the US, finally facing off more directly. The gloves have come off, basically. It has gone up faster than I would have thought right now, because I'm actually a long-term bull on both monetary metals. I think this bull market has years to run. So I don't think we should be in that blow off top. Even the most diehard silver bulls would tell you silver lags at first and then more than catches up at the end, right? We all know that. So if we're in the silver catches up part, that implies we're towards the end of this bull market. And that's not my outlook at all. So to the degree that I had anything negative to say and deserved the Darth moniker this year, it would be that, I was unhappy that silver looked like it was catching up. And in fact, if you look at the charts from the bottom, not the peaks. I don't know why everybody likes to look at past peaks, but gains are calculated from bottoms, from troughs to peak. So if you look at the last bottom in 2015, silver has now caught up to gold on a percentage gain basis. If you're a long-term bull, that should be a concern. We don't want silver to catch up yet. We want, years ahead of bull market to run.
Silver racing ahead sounds bullish, but historically it's often the first warning sign that a cycle may be aging, not beginning. As Lobo Tiggre emphasizes, silver typically lags early and only outperforms near bull market exhaustion, which contradicts the idea of a young, multi-year run. Since the 2015 bottom, silver matching gold's percentage gains compresses future upside rather than expanding it. That's a nuance most bullish headlines skip. Long-term investors should watch relative performance, not absolute price excitement, because timing matters as much as direction. What Lobo Tiggre says next reframes why speed itself can be a risk.
So yes, I have been saying, be careful what you wish for. I don't want silver to do that, blow off top catch up thing yet. And so it was a concern that it went so high so quickly. But the reasons for that are not because somehow the debasement trade has gone into overdrive or the macro context has monetary metals going vertical. Gold is still sideways. Okay, we've come back up from 4,000 when we last spoke, but we haven't hit a new all-time high, whereas silver has, at least nominally. So it's specific to silver. It's not a monetary metals thing, it's a silver thing. And as many of your guests, I'm sure, have probably told your audience, they don't need me to wax rhapsodic about it. There have been supply issues in London and elsewhere. India's been loading up. So it seems to be, in my view, a silver-specific thing, which means it's probably not going to last forever. I expect silver to consolidate again at some point here. Maybe it goes up. The technical guys tell me it goes up to 68, something like that, just below 70, and then maybe corrects for a while.
The key insight here is separation, not celebration. Gold staying range-bound while silver spikes tells you this move isn't macro-driven debasement but a localized supply squeeze. London inventory tightness and India's demand surge are real. Yet historically, those forces fade faster than monetary trends. Silver hitting nominal highs without gold, confirming often leads to consolidation, not continuation. As Lobo Tiggre implies, this looks tactical, not structural. Investors chasing this move as a new paradigm risk confusing a supply hiccup with a lasting shift. The next phase depends less on excitement and more on whether gold resumes leadership.
I don't know. I don't have a horse in that race. But the bottom line here is I'm not bearish because silver is doing that blow off top thing. I don't think we're there yet. I'm bullish because silver's gone up for idiosyncratic reasons. And if it corrects for a while, I think that creates buying opportunities before the next big leg up. So We kind of covered a couple things here at once, David, but I'm overall, the bottom line is I'm, for reasons that your audience is well aware of, very bullish on both monetary metals, and I'm not concerned about silver outperforming right now. I think that sorts itself out, and then we keep going on the trend that we've been.
I have here a chart of silver, gold, and copper. Year to date, silver's up 120%, gold next at 62%, copper last place at a measly 33%. What are we going to do with that? Now, Lobo, if you were allergic to buying something at all-time highs, one would have missed the rally on gold over the last 2 years, because ever since basically $2,000 and change, it's been at an all-time high.
There. Look at that chart, because I don't want you. Sorry, I don't mean to interrupt.
120% silver gain grabs attention, but context decides whether it's opportunity or trap. Lobo Tiggre isn't bearish. He's selective, arguing corrections born from idiosyncratic moves can reset risk before continuation. Gold's 62% rise since clearing $2,000 shows leadership doesn't require constant new highs. Meanwhile, copper's lag at 33% highlights how uneven capital flows really are. Wall Street loves ranking returns, but disciplined investors focus on entry quality, not leaderboard bragging. The interruption here matters because it exposes how performance charts often pressure people into buying strength without strategy.
Actually, I do mean to interrupt, but I want you to look at the chart you've got on the screen now. Look at the lines. And yes, we had these big surges in 2000, but then we had years of consolidation and substantial drawdowns.
Yeah.
$2,000 for gold 2020, I think I can't see it chart, but I think that's what we're looking at. So that's what I'm saying. I'm not saying wait for gold to go back to what was the previous low, 1300 or 2001. I'm not saying to wait for it to go down to $258 an ounce. I'm saying that if people can't see what I'm pointing at, but that first surge on the left-hand side of your screen there, I wouldn't buy that. But months later, where it's wiggled down, then yes, I would buy that, as long as I was still confident in the thesis. And
so would you,
from the beginning of our conversation here, I'm confident in the thesis. I just don't want to buy that spike on the right.
which of these would you still buy right now, given their moves already?
And you don't have it on there, but uranium too. This is exactly the thing. For people who are frustrated.
This is a lesson Wall Street rarely teaches. Patience is part of conviction. Lobo Tiggre points out that gold's strongest long-term gains followed consolidation after the 2020 surge above $2,000, not the initial spike. Buying strength feels safe emotionally, but often delivers poor risk-adjusted returns. History shows multi-year pauses build healthier bases than vertical runs. His approach separates belief in a thesis from reckless timing. Investors frustrated by waiting often overpay for momentum, forgetting that consolidation, not excitement, is where future upside is quietly prepared. Next, Lobo Tiggre talks why this mindset matters beyond gold alone.
And saying, Lobo, it's going, and you're just sitting on your hand. No, I'm not. If you want to buy high and hope to sell higher, well, knock yourself out. I was taught to buy low and sell high. So when things, even if I like them, they're high, then I look for something else that isn't. And to go with your chart here, copper has afforded opportunities. There are copper stocks on my shopping list right now for this very reason. You can still find things that are available to buy low. And uranium is even better because the spot price has been highly volatile in the last few months, but the long-term contract price, which is the real uranium market, is actually going up. So if the real market's going up and the spot price has stocks on sale, my most recent purchases have all been uranium stocks because of that volatility. This is an old Doug Casey thing, my mentor. He used to say, make volatility your friend. That's exactly what I've been doing. And I expect to do that in gold and silver going forward.
What is the copper trade going into 2026 then? If you think AI is overpriced and perhaps on the way to a bubble pop, what's driving copper to higher prices?
This is where discipline quietly outperforms excitement, even when markets feel like they're leaving you behind. As Lobo Tiggre makes clear, buying strength is emotionally satisfying, but mathematically dangerous, especially after triple-digit percentage moves like silver's. Uranium is a textbook example of the disconnect between volatile spot prices and rising long-term contract pricing, which is where utilities actually secure supply. Doug Casey's volatility framework applies here because price swings often create mispricing, not risk. For long-term investors, this approach shifts focus from momentum to margin of safety. Next, Lobo Tiggre explains why copper fits this same playbook with lower headline drama.
Well, first off, it's Dr. Copper, right? It's a fundamental industrial mineral. It's like iron. Like you can't have civilization without it. We can't have modern civilization without copper. Some people like to say copper is the new oil, right? I don't quite agree with that, but I understand the sentiment and there is a reason for it. So it is absolutely fundamental. And copper was and would go up even without the electric cars and without the AI. It's essential anyway. And the supply is constrained. Even more than uranium, actually. But the kind of mega projects that are needed to continue to fuel the world or supply the world with copper are few and far between, very hard to permit. Even the Trump administration has struggled to get a resolution to a famous copper project in the United States. So sorry, one more quick comparison there for the ones that are on sale or relatively on sale. Unlike uranium, there's no nuclear accident that can take copper out and melt our portfolios down. And that can happen in the uranium space. So the lack of that risk makes me, I like both copper and uranium for being cheaper right now or relatively cheaper.
Copper's story isn't hype-driven demand, it's slow-moving scarcity colliding with modern infrastructure needs. As Tiggre highlights, copper demand existed long before EVs and AI, which means its thesis doesn't collapse if tech enthusiasm cools. Global permitting delays and capital intensity have constrained new supply for over a decade, according to the International Copper Study Group. Unlike uranium, copper lacks catastrophic headline risk, making volatility more digestible for conservative portfolios. This is why institutional capital often treats copper as a confidence trade, not a speculation. Next, Lobo Tiggre explains why that confidence matters most when markets start doubting growth narratives.
But copper is the lowest risk, which goes to the 2026 outlook question of, why is copper again my top pick for 2026? It's not because I necessarily think copper will go up more than gold or silver or uranium. It's because I have the highest confidence that it will, and that I think it will be substantial. The supply side is deeply constrained. And by the way, even if the AI bubble unwinds, it's not like there'll be no AI. And like another big news headline today is that Ford's taking a $19 billion write down. I'm sorry, it's not funny. But a $19 billion write down on having gotten a little too enthusiastic on the EVs. And now it's going with hybrids and other things and gas guzzlers. And the stock is up on that news last I saw, despite the write down, right? So they're still not going away. And by the way, the hybrids, they use a lot more copper and other critical minerals than the regular gas cars. So what I'm saying is the potential headwinds or corrections that we've talked about.
This is where media narratives quietly collapse under real-world math. Ford's $19 billion EV write-down didn't kill copper demand, because electrification didn't disappear. It simply shifted form. Hybrids, grid upgrades, and industrial electrification still require significantly more copper per unit than legacy systems. Lobo Tigre's confidence isn't about upside bragging rights, it's about probability-weighted outcomes. Even if AI cools, infrastructure doesn't reverse. Wall Street tends to frame write-downs as demand destruction, but markets often reward strategic retreat. The final piece explains why volatility doesn't invalidate the thesis, it reinforces it.
They don't torpedo the underlying thesis, not for uranium, not for copper, certainly not for gold and silver, monetary metals. So I don't see that volatility as a negative at all. I see it as a good thing for anybody who's looking to deploy more capital in this space.
Volatility only feels dangerous when investors confuse price movement with thesis failure. As Lobo Tiggre frames it, corrections don't negate long-term fundamentals across uranium, copper, or monetary metals. Historically, some of the best multi-year returns followed periods of sharp uncertainty, including post-2008 and post-2020 drawdowns. What matters is whether supply, policy, and demand structures change, not daily price action. For patient capital, volatility is a pricing mechanism, not a warning signal. The real risk isn't fluctuation, it's reacting emotionally instead of strategically when markets hand out opportunity.
This is from JP Morgan. This is not, I don't have to remind the audience and yourself, this is not an insignificant institution publishing an insignificant post. This is their forecast officially $5,000 by the fourth quarter of 2026 with $6,000 an ounce possibility longer term. Now, there was a time when I was working at my last job when you and I first met when we were talking about $5,000 gold as a hypothetical doom scenario. It is now no longer that hypothetical doom scenario. We're not at 5,000. I'm not saying it's going to happen tomorrow, but here we have a major bank saying it's not going to happen by the end of the decade. It's going to happen by the end of next year. And I'm not going to read the entire article, but spoiler alert, not much has to change. Central banks have to continue buying, and the Trump administration has to continue putting pressure on the Federal Reserve. The Federal Reserve losing independence is one of their criteria. But let's just take this at face value. Gold is going towards $5,000. What has fundamentally changed in the world such that we're talking about this at the end of 2025 and it's just status quo versus 5 years ago, this was a hypothetical scenario that was like the end of the world needs to happen for this to happen?
The real shock isn't the $5,000 number, it's how calmly JP Morgan now treats it as baseline instead of catastrophe. When the largest US bank shifts gold from a doom hedge to a near-term forecast, it signals a structural loss of faith in monetary stability, not speculation. Central banks added over 1,000 tons of gold in recent years, the fastest pace on record, quietly validating this view. Pressure on the Fed's independence, especially under election cycles, accelerates that trend. As Lobo Tiggre often notes, gold doesn't rise because things improve. It rises when confidence erodes gradually, then all at once. What follows explains why this normalization of extreme prices matters far more than the headline itself.
Well, let's come back to what's changed. Let's go to the first bit, because I think that's really interesting. I've had people say, well, gee, Lobo, you said if gold went to 5,000 or 10,000, and those were commonly numbers that were thrown out, 5,000 or 10,000, we'd be looking at a Mad Max scenario, or the world would be totally crazy.
Yes, exactly.
Okay, it's not Mad Max, but the world looks pretty crazy to me, David. I mean, we've got a hot war in Europe. I mean, that okay, it hasn't gone nuclear yet, and there's talk about peace, but no actual peace. The bombings and strafings on both sides continue. We had a hot war in the Middle East, hotter than in decades, and that seems to have simmered down. But you think Iran has given up on their goals or perspective, or I think and actually we don't actually have a peace deal in the Middle East. We have a ceasefire, and it's held, but who knows how long it'll hold. Point is, there's geopolitical, not just risk or tension, but there is actual fires burning on the geopolitical front in our world right now.
Gold doesn't need Mad Max. It only needs persistent disorder that never quite resolves. Markets still price geopolitics as temporary noise. Yet Europe's war has stretched years, not months, and Middle East ceasefires remain fragile by design. Historically, sustained conflicts, not sudden shocks, drive reserve shifts, as seen in the 1970s and post-2008 cycles. Investors underestimate how contained wars slowly harden into permanent risk premiums. As Lobo Tiggre has warned, prolonged geopolitical fragmentation reshapes capital flows long before headlines turn apocalyptic. Next, he connects these conflicts to an even deeper force most portfolios still ignore. And
then you've got the trade war, which isn't just a trade war. This is global superpowers, China and the US, finally, facing off more directly. The gloves have come off, basically. And the hegemon existent and the hegemon uprising are openly jockeying for position here. That is a scary world in which that sort of thing is happening. And then we've got the debasement trade, all these other things going on. So, it is a pretty different world from where it was when we, years ago, thought that 5,000 would be a crazy number. Well, we live in pretty crazy times. And then as far as what's changed, we've touched on these already. The central bank buying, that's absolutely a game changer. It's not going away anytime soon. I think this other thing we've just talked about, where the reallocation to gold in portfolios, where it's not just gold, but I mean, that Jamie Dimon thing JP Morgan thing you just quoted. Remember Jamie Dimon a couple of weeks ago, he said, well, it's not entirely insane to own gold these days. And it's one thing for longtime gold bugs like Gundlach who talk about, 25% is not excessive. And even though he walked that back, he did say that a 25% allocation to gold is not excessive.
This isn't a trade dispute. It's a slow-motion monetary regime change hiding behind tariffs. When the US and China openly challenge each other, currency credibility becomes collateral damage, and gold fills the trust vacuum. Central banks buying gold while reducing dollar exposure confirms that debasement fears aren't fringe anymore. Jamie Dimon conceding gold ownership legitimacy marks a psychological pivot Wall Street rarely reverses. Even Jeffrey Gundlach floating 25% allocations, walked back or not, reframes risk models across institutions. What Lobo Tiggre says next shows why this shift may still be underestimated by most investors.
But he's been into gold for many years. For JP Morgan, that institution that gold bugs love to hate, for that, the leader of that institution to come out and say, well, you know what, it's not just, crazy people who want to own gold these days. That is a huge shift. And I forget there was another one, I think it was Morgan Stanley that was recommending a 10% allocation or something like that to gold. That's huge. And to the degree that it doesn't happen overnight, but to the degree that their clients or anybody listening to them starts doing that this is enormous. So under any other circumstances, the answer to your question actually, David, is if we were in that world from before and we were looking at $5,000 or $4,000 or $5,000 gold, $60, $70 silver, I'd be very worried that we just hit a peak and the next big move would be downwards. But for these reasons, the world that we're actually in today, I think we're actually in a consolidation phase before another move higher. How much higher? I don't know. I don't do the crystal ball thing. I'm happy just to get the direction right, and it'll do wonders for my portfolio if I do.
The quiet revolution is not price. It's allocation policy changing without fanfare. When institutions like Morgan Stanley float 10% gold exposure, that's not tactical. It's structural, even if clients move slowly. A reallocation of just a few percentage points from bonds into gold represents trillions over time. In prior cycles, such shifts marked beginnings, not tops. The media frames consolidation as exhaustion, but historically, it's how markets digest new buyers. As seasoned allocators know, direction matters more than precision.